Hey, greetings, KW City View. Hey, welcome to the February 6th week edition of Headlines and Market Stats and MOFIRS. And let's go through what's making the news right now and some of the factors that are impacting our real estate market here in San Antonio and what our message might need to be to the people in our database. What is the MOFIR, the making offer for immediate response? It's going to invite them in to explore the opportunities of the market. Let's dig in. And here, I'm going to go ahead and share my screen. And let's see if we can get that to take hold here. Here we go. And we'll go full screen. And let's take a look at the headlines. And luxury home sales, are they carrying the San Antonio housing market? The answer is they're doing pretty well. In fact, when you look at the headline here, homes priced over $1 million, actually seeing average 3.1% above listing price, according to December data. You've got a couple of agents commenting, Jason Glass, about last 2 weeks of January being kind of bonkers. Having a listing that sat on the market 9 months after having expired with another agent, no change in price, and all of a sudden full price contract. So we're seeing still a shortage of really good homes in the luxury space. So might be a good opportunity for somebody that, is wanting to make a move in that market to still capitalize on a strong housing market for luxury. But let's take a look at some other things. Housing starts dropped for another consecutive quarter. Hughes said that he anticipates starts to continue to decline until the market sheds enough inventory to make building homes viable again. And so what were the stats? There was 2,274 starts for the fourth quarter, and that was a 47% decline from the third quarter. If you go back, our record quarter was 6,736 starts in the second quarter of 2022. And they're anticipating somewhere between 16 and 17,000 housing starts this year, which is in kind of along the lines of 2020, before things really super heated up. Here are some key points, and I want you to take these in, and we'll get you these slides too. I'll send them to Amy, and we can make sure we get them to you. We're going to get back to sustainable pace of building, he said, where the trade workers remain employed, but not putting ourselves in a position where we don't have enough worker supplies or any of the problems that we've had over the last 2 years. I think that might be understated. I think it could get kind of bonkers by the time we get back to, mid 2024. We'll see how that plays out. But he goes on and says, anticipates that starts to continue to decline until the market shades enough inventory to make building more homes viable again. Now, here's the key point he makes. This is not way off into the, 2 years from now. He says, we will sell through enough inventory. It might take 1, 2, or 3 quarters. 1, 2, or 3 quarters, which means right now with the discounts and incentives, there's demand out there. There are probably a few builders and spots that still haven't got their pricing in the right spot. Go negotiate. He warned that as the market stabilizes, those discounts and incentives are going to start to be phased out because they won't be as needed. And that could be going into as soon as the second or third quarter, certainly by end of the year. So one of the things we talk about is often this window of opportunity, because remember this article, San Antonio is considered underproduced in housing. And so we're going to get back to a place of tightness of inventory probably fairly quickly. We see it in the luxury space. Plus, we know that luxury buyers aren't as impacted by inflation and interest rates. Talking about interest rates, remember that our longer-term rate, we've got this in that consulting guide that we developed for you guys, is 5.97 going back to the late 80s, going back to actually 91. And right now we're seeing 5.99 advertised. We're about 6.02, maybe 6.1 interest rate right now on a 30-year mortgage. So we're at normal. And this may be the best that we see anytime soon, unless we have a significant recession. I do not believe you're going to see sub 5% interest rates anytime soon, maybe not for a decade. And I'll tell you why, and it has a lot to do with what we've talked about before in some of our segments. It's about the consumer being strong. It's about consumer spending demographics, and it's also about workforce challenges, which is causing salaries to go up. In fact, if we look at this article, 5 sobering stats that should be a wake-up call for employers. And, hiring managers talking about the challenge it is to compete for good people. The 5 points they talk about: the gap between available workers and jobs. There's 10.7 million job openings and 5.9 million unemployed people. Figure that one out. Some insights. It says this remains one of the strongest job markets in the past 50 years. No comfort for those hoping for a slowdown, which would reduce inflation and lead to a less aggressive path of rate hikes from the Federal Reserve. This was from the Mortgage Bankers Association chief economist. Number 2, roughly 30% drop in birth rate since 2008. Now, we've talked about demographics. This is part of what will create a future worker shortage. Talked about higher education, planning in a 15% drop in enrollment of college students. And extend that another 4 or 5 years, and you have a smaller workforce available to fill jobs, which means, supply and demand, smaller workforce, higher wages. You look at the demographics. We've looked at this before in our consulting guide, where we looked at the consumer. And, you started to see the downward trend starting around 2008. And then look what happens. 2007 was the peak, and see the steep decline in birth rates. That's your future workforce. And we may be in a place of sustained inflation rates that probably not going to get back to 2%. So at the economic summit in Austin, and the economist said that the Fed's target of a 2% inflation rate is folly, that he's hopeful that they'll come to their senses and say that better targets, at least an interim target of 4% is reasonable, and with wage growth may be sustainable. Now, point number 3, 31% of employers are evaluating candidates outside their company's geography and allowing new hires to live anywhere. Point number 4, 4.1% average raise plan for 2023. So people are putting, and by the way, in high demand markets, that's probably higher. That's a national number. This is interesting. The 1.7% drop in earnings for employees who stayed put. Now, that's real earnings. Let's look at this. The median worker who changed jobs between April 21 and March 22 saw an increase of 9.7% in real earnings when adjusted for inflation. Key thing, when adjusted for inflation. The median worker who stayed put experienced a loss of 1.7 in real earnings. Again, adjusted for inflation. So didn't mean they didn't get an earnings increase. It just wasn't as enough to cover inflation. Whereas people that were job changing were actually, after inflation adjustments, having almost a 10% bump. So housing affordability is improving with wage increases. And so that's kind of the story of what's making headlines today. And what's the message to our consumer today? The message might be housing incentives liable to dry up by end of the year. Window of opportunity to get your best deal might be now. If you have any plans, now here's your MOFIR. If you have any plans in real estate in the next 12 to 24 months, please contact me to schedule a no obligation strategy session to talk about the factors that are impacting our housing market today and into the future. And so messages, window of opportunity. I've said it so much, and boy, it just keeps getting validated by the headlines, by the statistics, by the documentation. So have some thoughts around this. Curious what you think. Have a great one. See ya. Bye.